So we talked about it. We're gonna have an exam this Saturday and Sunday. It's gonna be available like 12 a.m. Instead of 0 a.m., 12 a.m. I never figured out 12 a.m. Saturday, and then to 11:59 p.m. Sunday. So you have you can find the exam in the quiz and exams folder. It's gonna be it's gonna be a Word or PDF. You're gonna be able to download it, and then you I'm gonna make an announcement about it. Then you can finish with Excel. All right, finish with Excel. I'm gonna be giving out some more specific requirements in the announcements. So you have 48 hours to upload it. The link to upload your answer will be available for 48 hours by the end of Sunday. Right after that, you can enjoy your spring break. Any questions? If you feel really comfortable like today's class, we can still ask about consolidation. If you feel very, very comfortable about the homework, about what we are going to be doing, you should be good. All right, you should be good. It's not easy, but I don't think it's too difficult. All right, just don't forget what we learned in January and early February. All right. So let me share my screen with you. Last week, we did the 5 steps. We didn't do the consolidation. So today we're gonna do the consolidation, then we're gonna do the homework again together. Yeah, and if we do it like this, the next 2 exams should be easier. I decided to adjust for it, given that we missed 1 week and everything, and COVID still, right? So let me share my screen with you. How to share? Can y'all see it?
Yes.
Yes.
Good, good, good. Yeah, so there are people. Okay. Yes. See, wait a minute. Okay. So one thing about consolidation, we talked about in the previous classes, right? The parent company and the subsidiaries, they are treated like independent companies, right? So think about it. They are like 2 companies. So it is impossible for us to imagine that 2 companies sharing the same accounting system. So generally, we can say that subsidiaries keeps their own accounting system, and the parent company keeps their own accounting system to their own financial reporting. And but when it comes to consolidated, we are talking about financial reporting for the whole group, right? Then we have to ask ourselves one question, right? Is it worth it for the company to use another independent assistant just for the purpose of consolidation? The consolidation is done like twice at most, twice a year, right? So it's extremely useless to use another independent accounting system, financial reporting system, just for the sake of consolidation reporting, which happens like twice a year at most. Okay, so when we talk about consolidation, of course, people use some kind of easy accounting stuff, but it's not like the accounting system we are talking about. So every year, financial reporting team, they will take raw. I say raw because they will take financial statements from parent companies and from subsidiaries and put them and do the consolidation adjustments. Every year they do it from scratch, right? So we talked about these 5 steps. How do we start with 5 steps? Okay, so every year, this is pretty mechanical. So every year, what happens was So I'm recording this, so don't worry too much. I'll just call it total. Every year, what happens was the consolidation team, they would just grab the raw financial statements from big and small, right? Reported by themselves. And their first step is to add everything together, with the exception of a few numbers, okay? With the exception of a few numbers. So for example, let me. I have to, align the thing. Otherwise, I will feel like really bad. So with exception of a few things, all right? So for example, net income, we know it is based on calculation, right? No matter which group you are reporting, you have all the income, you have all the revenue, you have all the expenses, and then you subtract expenses from net income, you will get from total revenue, you will get an expense. So net income is calculated. It's not something you just get it directly, right? There's no account called net income, okay? And this net income is an issue as well, because for statement of retained earnings, where do we get a net income? We get a net income from income statement, right? So net income is, when we talk about financial statements, net income is from income statement, not something we calculated, all right? So again, for this net income, we have to borrow from here. And we also have dividends, right? Dividend is announced, we will talk about later. And then we should have this number, it's calculated. And investment account, it is fine, we're gonna talk about it. And of course, total, we have to adjust for it. Then here, retained earning, we have to calculate it. Then we can do our consolidation. Any questions so far? Nope, okay. So question number one, how much was the investment again? Do you remember? What's the balance of investment again?
Did we go through this last time?
Yeah, that's the thing we went through. We went through the 5 steps of consolidation last week, right? But we didn't do this. Right? I have the 5 steps consolidation here, remember? You were here, Stephanie, right?
No, I wasn't here last time, but I thought I watched the Zoom, so that's why I'm confused.
That's a Zoom thing, right? I think uploaded on, that's the thing. I think that's the same thing. Anyway,
Okay.
that's the 5 steps, okay? That's a 5 step. So first question. We can work on it just to see if you are sort of ready for the exams yet, okay? What number should we put here? How much was investment? How much should the investment can be by the end of 2014? Give me a number. Let's start from somewhere, all right?
Are we giving you any number?
That whatever you feel is correct, and tell me how you get it.
Oh. $10 million?
Why 10 million?
I just saw investment. I wasn't here last time, and I guess I didn't watch the video, but
No, it's fine.
Okay, on the left side.
Yeah, I know which one you're talking about.
Okay.
Anybody have other number candidates, whatever? Come on. What do you think about 10 million?
I have more of a question if it's before or after the 5 steps that we did.
What? It's aft, right? But it has nothing to do with the 5 steps. I'm just asking what
Okay.
should the balance of investment account by the end of 2014?
Would it be the 2.8 million?
Where's 2.8?
At the end of 2014, the retained earnings for small.
Why? We're still talking about the investment account, right? There are 2 accounts. And this goes back to the class we had in late January. Okay, so if we're unclear about it, we can go back and we talked about it. Homework covered it as well. So give me some clue, right? If you don't know, I'm not asking you to give me the number directly, but how would you get it? Where would you start? Right, it's important to know where to start instead of, I think, getting to the number directly. I don't think too many people can just get to the number. So where would you start to calculate any balance of investment account?
You'd start with the 10 million and then make any adjustments that were made to the investment account throughout the year.
Okay, so let's start from there, right? So why you start? So I'm asking for the balance by the end of 2014, right? Like I said, accounting is easy. It's always follow a pattern, and usually you start with beginning of the period, right? And you work on what happened in the period, and then you get what the balance was by the end of the period. I think that's what you're talking about, right, Amado?
Yes.
Yeah, so okay, let me also ask you, right? So you talk about adjustments. What are we adjustments? What are we adjusting indeed?
Anything that they received as sort of income from investment.
Okay, so
very small.
So okay, so anything? What is the thing? What do you think is the thing? Remember?
Would it be their net income or loss?
How much?
80% of it.
80% of what? Okay, so that's fine. Like I said, I think it's important to be able to, abstract information. So we know that when company big has a big stake in company small, right? So we use equity method, historical cost method, right? And when did one's investment, when would the biggest investment value go up, right? When the investee party is getting better, doing better, making some money, right? So in this case, which is investee party? It is small, right? So when small makes income, makes some good performance, big will recognize investment income, and their investment account balance should get higher as well, right? And if you remember, this information I give to you already. I didn't ask you to calculate, right? Investment income, right? You debit investment income, you debit investment account, credit investment income. So here, if you look at it, everything has been given to you already. Investment account balance at the beginning of the year is 10,000. Then from investment income, they made money. And so investment income brings up, increase, because you have had investment income, investment value went up, right? By the amount of investment income, 1,360,000. So when would the investment balance decrease? When would it go down?
The net loss.
Loss, yes, one thing. Other than loss, anything else could make it go down?
Dividends.
Dividends, right? It's a cashing process, like I talked about. You have 1,000 in your bank account, right? You have 1,000 in your bank account. If you work hard, make money, your bank account goes up, right? If you withdraw cash from the bank account, your bank account goes thinner, correct? So here it is a case, right? Dividend is like cash, cashing out, okay? The company made so much money, we have an option either to keep the money within the company, let it grow again, reinvestment, what we call, or we have the option to withdraw it for our personal use, for other users, right? So here, invest dividend, cashing out. How much?
I believe it says 1 million.
Why 1 minute?
Oh wait, no, that's the dividend as a total. So what is it? 80% of the, so it'd be 800,000.
Mm-hmm. Why? You're right.
Because Big only has 80% ownership of Small.
Right. So Small give out 1 million cash dividend, but we are asking investment company belongs to Big, right? So Big only received 800,000. This is what we are talking about. Can you see it?
Yes.
So now it's better. So we get it. Okay. 1, 2, Better hold a minute. So what did I do? How can it be? Oh. Okay. Okay. I sorry. I kind of forgot I have those stuff hidden. So let me. Move it here. What? I don't know what is. Okay. Now it looks better. See, now this balances. So here we get our ending balance, right? Ending balance of investment. Can you see that? Right here. Okay, that's how we calculate it. So let me ask you another question, right? So just try it, all right? We talked about it last class, but maybe we didn't spend a lot of time on this, right? So what's for the group, what should the beginning balance of NCI be? For the group, what's the beginning balance of NCI? What is NCI again? Anybody can remind me?
Non-controlling.
Yeah.
Sorry, go ahead. That's okay. Lady first, maybe. Who was talking? No? Okay, then Amada, you go. What's NCI again?
It's the hello.
Yeah, I can hear
Non-controlling
you.
interest.
Oh, okay.
Non-controlling
Yeah, okay.
interest.
Yeah. What did you say, Ashley?
I was getting ready to say it's not greater. It's the non-controlling interest is not greater than 50%.
No,
I
it
thought-
doesn't. Not. We call it. I think non-controlling interest good. Sometimes it can be larger than 50%, but it's not covered
then-
in our
But less
class.
than 100% though, right?
Oh, of
So then
course.
it would,
The key is
so then it would
non-controlling,
be
right? Yeah.
right. So
Uh-huh.
then it would be the 80%. I guess the beginning balance of non-controlling would be the 12.5 million
Why 12.5?
because it has the 80% next to it, and that's greater than 50, but
Okay.
less than 100.
So let's do this. Okay. Let me see. Where did my row? Where's my? What is happening here? You got. Where's my? Okay. I don't know what is going on. Okay, better. So here, right, one issue. So when we talk about non-controlling, let me ask Ashley. I think she brought this up. So I'm asking about non-controlling, right? So we know. So where do you get that 12.5 million? What is this 12.5?
Right there.
What?
I said from right there. It's the well, okay, wait, maybe not the 12.5, maybe it's the 10 because Big
No.
paid the
10 belongs to whom? 10 belongs
To
to
Big.
Big. Big is a
Right.
controlling party, right?
right.
So what is 12.5 again? Big paid 10 million for 80%, which means from the perspective of Big, the whole
Uh-huh.
package is worth 12.5 million, right?
Right.
And if Big's interest is worth 10 million, who owns the other 20%?
Small.
Non-controlling interests,
Okay.
right? That's a different thing. This is a company. Small is a company. Big owns 80%, and non-controlling interests owns 20%, right?
Yes.
So non-controlling NCI at January 1st, 2014, the balance is, I'm going to subtract it, okay? So you can have a better idea. The balance is 2.5 million. Are we good?
Yes.
Right? Okay. So here is another question, right? When small make money, has some earning, should the non-NCI's value go up as well?
Ask that one more time. I'm sorry.
When small earns income, should the value of NCI goes up as well?
No.
Why no? You own 20% of a company. If that company does better, don't your investment value goes up as well?
Well, yes, your investment would go up, but that doesn't mean that your percentage of the company would go
No,
up.
no, it's not a percentage. I'm talking about a value, right? We make
Oh,
joint
the
ventures
value.
not for percentage, but only for value. Remember,
Yes,
right? That goes up as well, right?
yes.
So big owns 80%, means whatever big will get 80% of the income, and a small will get, sorry, NCI will get a 20% of the income, right? So you see here, out of the income small made, big took 80%, which is 1,360,000, correct? So how much net income should go to small, should go to NCI? How much income small made should go to NCI?
20%.
20% of, so how much? How much is that?
Where is their net income? Or where is their net income?
No, you don't need that. But you can take a look at it.
340,000.
Why 340,000?
If the 1,360,000 is 80%, then 20% would be 340.
Yeah, 20% is a quarter of 80%, right? So 20% is a quarter of 80%, right? If we know 1,360,000 went to big, then we know there must be a quarter of that number goes to small, goes to NCI.
Sorry, sir. I don't mean to be pedantic, but you said a quarter. Shouldn't it be 1/5?
No, a quarter of the income went to, so NCI claims 20%, right? Big claims 80%. 20% is a quarter of 80%, right? I'm talking about a quarter of this number.
Right. Yes.
Are we good?
Got it. Thank you.
So when small give dividends, does money go to NCI as well? Remember, we talked about NCI, but NCI are actually shareholders of big, of small, right? So when small give cash dividends, does money go to NCI as well? It's a yes or no question, right? Just try it.
Yes, I think it should.
You should.
Yes.
Anybody else? Yeah, it should, right? So it's a like thing. Think about it. Or we said when small give cash dividend, company small actually gets smaller, right? It gets less valuable. So investment, so company small gets less valuable, more like your bank account gets thinner, right? So your bank account gets thinner. Whoever claims 80%, the investment account here we talk about, they will get a small as well. So of course, NCI will get smaller as well. All right. So here, 80% of 1 million, 80% of 1 million here went to big. So the rest 20% went to NCI. Okay, so let's do some consolidation, all right? So we have the 5 steps of consolidation here. Remember, that's what we did last time. So what should our consolidated revenue be? How much should the consolidated revenue be?
100 million.
That shouldn't change, right? Because there's nothing we have. Remember, how do we do consolidation? We look at the total that we add the account numbers from different parties together. Then we look at our 5 steps to see if anything is affected here, with the exception of the accounts I talked about, okay? So here we have no journal entries affecting, we have no journal entry touching revenue. We have no journal entry involving cost of goods sold. So those 2 accounts should be the same. All right, so what about depreciation? How much should a consolidated depreciation expense be?
2,600,000.
Sorry? You said 3 million.
600,000.
600,000, let me see.
Because we're subtracting the 400,000.
Oh yeah, so 2 million, right? 2,600,000, right? Is that what you're talking about?
Yes, that's what I said.
Yeah, I thought you said 3 million. And then why it is that? Remember, we can do it like this way. So we add the depreciation expense reported by big and small together, give us 3 million. And we look at the 5 steps we did. We look at step 5. We see that depreciation expense was credited for 400,000. Credit balance to expense, meaning reducing the expense. So we have expense reduced from 3 million by 400,000, which gives us 2,600,000, right? That's one way we can do it, or we can more like to justify it, right? Big reported depreciation expense of 2 million, small reported depreciation expense of 1 million. But we know because consolidation should be from BIG's perspective, and from BIG's perspective, depreciation of small assets should only be 600,000 per year instead of 1 million per year, right? So instead of 3 million, the consolidated depreciation expense should be 2,600,000. So we can understand it from 2 different perspectives. Any questions? Okay, so follow the same spirit. We know that amortization expense should be, let me take a look. Should be 1,700,000. Why one? Anybody have questions about why 1,700,000? I think we talked about it the week before last week, right? Anybody got questions? Same stuff, right? We can either do it, get the number from the total, and check step 5, which involves expenses. We know it should be the total with 500,000 more because it's a debit adjustments, right? Or we know that this is 200,000 is what small reported. But we know from BIG's perspective, we have 2 things we need to adjust. Patent is valued 300,000, 3 million more, so every year 300,000 more. And the customer list is valued 2 million more, so every year 200,000 more. So instead of reporting a total amortization 1,200,000, it should be 1,700,000. All right. So how much is investment income? How much should consolidated investment income be?
0.
0, right? Why? How do we get it?
Because in step 3, we added back the 1,360,000.
Yeah, that's what I want, right? because we look at it, we talk about why conceptually already, but we do the 5 steps. We know what here is, there's an income balance of credit balance of 1,360,000 already. Instead of 3, we debit it. So it's gonna be net off, right? So 0, right? Yep, what I put. I think I must have set my Excel, maybe something wrong with my Excel. Okay, we good. And do you notice what's the difference? What's the difference between this and this?
340,000.
Right, is 340,000 is what we said went to NCA, right? Because when we talk about the group's income, those income earned by NCA should count as well, right? That belongs to NCA should be counted in as well. So we have this number here. We good? Now let's skip this a little bit, and we can talk about. So what is consolidated cash, right? We had nothing touching cash. So this is what we have. All the way till PPE. So how much should, what should be the consolidated balance of PPE?
17,900,000.
Okay, I don't know, I need to calculate. So we know when we add them together, it's 19,500,000. And let's take a look at step 2. We have a credit item of 2 million. So we subtract this. And if we look at a step 3, it's nothing. Step 4, nothing. Step 5, we have debit balance of 400,000. So we add it, right? Is that what you said, Heather?
Yes, that's what I said.
That's what you said, okay. So here's how we do it, all right? So for land, we do the same stuff. The difference here, we only have step 2 involving land, debit balance 2 million. So the total land here, we have 52 million, and the consolidated land balance should be the total land plus the 2 million debit sides. So we have 54 million. And for investments, we do similar stuff. The consolidated balance, total balance is 10,560,000, like we talked about. And we look at the investment here. We first have a credit balance in the amount of 3,200,000. So we subtract it. And then we have another credit balance in the amount of 6,800,000. So it's credit balance. So we subtract it again. And then we have another credit balance of 1,360,000 from step 3. We subtract once more, and in step 4 we have debit balance of 800,000, so we add it back. If I did everything right, it should be 0. See, it's going to be adjusted automatically. So for customer list, we do the same stuff. The raw financial statements, big and small, they all show 0, so it's 0 total. But we know that in step 2, we have an adjustment for the balance of 2 million. And then in step 5, we have credit balance of 200,000. So we subtract 200,000, which gives us 1,800,000. For goodwill, 0. And then for patents, we do similar stuff. We started with 21,800,000, and we know that here, step 2, we have adjustments for patent in the amount of 3 million. Then in step 5, we have credit balance for patent in the amount of 300,000. So we subtract 300,000. And here's what we have. Any questions? Any questions so far? It's a good time to ask.
So will you be posting this Excel
Yeah.
spreadsheet
Yeah,
separate
I will
from
post the video, okay?
But would you be able to just post the spreadsheet, the actual spreadsheet?
Yeah, I will post it as well, like last time, right?
Okay.
But just follow me in the class first, all right? So for bank loan, we do the same stuff. We have nothing touching bank loan, right? Now here's an issue. How much should a consolidated common stock be?
$5 million.
5 million again, right? How did you get it?
Where'd I go? 5 million plus the 1 million gives you 6 million, but then we have to, I guess, reduce it, but you're really adding them. These are negative numbers. But in step 1, you have the 1,000.
Yeah, 1 minute.
Sorry, 1 million.
Okay. Yep. So for additional paid-in capital, we do the same stuff. What about retained earnings? Okay, so forget retained earnings, right? What about NCI? What should the ending balance be with NCI be? How much is NCI's ending balance?
2,640,000.
Like we just did, right? So don't hesitate, right? We just calculated. We know this. So the only issue we have is NCI. We're gonna talk about it, but here, let me just show somewhat like hint, right? Like a way to take care of accounting stuff. Okay, so it's just a trick, right? Sometimes in exams, do CPA, you might use this. So if you are confident about your answer, and we know that for balance sheets, you have to, make it a balance, right? So there's nothing we can do here. The total balance here is gonna be 139,200,000. So total liability, total equity should be the same number as well. If we sure there's nothing we can do about it, we are very likely to be correct, but we cannot figure out how much retained earning is. We can just fill out this number first, right? And from this number, we can sort of gauge out it, right? It's the same. Like I said, remember we talked about when we do the consolidation at first, we don't change those numbers. So keep in mind, those common stock, additional paid-in capital, retained earnings, within the context of our class, it should always be the same because I don't touch you within the year equity transactions, right? Are we good? So what is the beginning balance of retained earnings? Right? Retained earnings here, we have the total 332 million. And remember here, we adjust beginning balance to retained earnings here, right? So what we have here is debit item of 2 million. So we do the same stuff. When we do adjust for retained earnings, we do the adjustments here, okay? And what is the net income again?
$18,360,000.
What's the dividend? Let me just make it more straightforward. What's the dividend? Okay, let's try this. Okay, let's try this. A little bit of difference. We'll talk about it. If we just put 600,000 here without any adjustments, what issue do we have? We got time, no worries. What issue do we have here? Should it be 600,000?
No, it should
Oh, sorry, should it be 6 million?
be 5 million
Why 5 million?
because of the 1 million right in step 4.
No, I'm talking about a different way here. Right, so we know from this, we know the return earnings by the end of the year should be the same as here, right? Let me check a few numbers. Yep. So what's the issue we have here?
It's not matching with the retained earnings further down below.
Mm-hmm. So let me give you some stuff else. What about so if it is 5,340,000, what are we talking about? So no worries. This is a tricky part. I don't really want to cover it at all tonight, to be honest. We have this issue. We have this kind of inconsistency here because of for the reason here. When we talk about net income, we are talking about a net income to the whole group. And when we talk about a retained earnings should actually be the only thing that are counted too big, right? So we have some differences here. Here, net income includes the income earned by big and the 80% of small owned by big, and plus the 20% goes to small, right? So we should tease these parts. So when we fill out these, just keep in mind we don't really need all these. All we can do, we can do some stuff like this. Just keep the original number here, and so it's all be good. Okay. for retained earnings, it's actually not so complicated. Other things are fun. So we're doing this. We have a everything just you know, works out. Are we good? I'm gonna save this so everybody has it. Okay, everybody has it. I'll upload it. Now let's talk about homework. I forgot to delete sheet 2. Sheet 2 was what I'm supposed to give you if we didn't have storm and everything or COVID. But you know, just don't mind sheet 2. I forgot to drop it. So sheet 2 is so the homework is actually not so different from the practice, right? So let me ask a question, right? How much is this? How much is the balance of cash? What does this in M mean?
In millions.
Yeah, in millions, right? Small details, just pay attention to this. You will see these a lot, okay? So question number 2. So we don't have to finish all these, right? Just for, like I said, for you to think about it. This one is more difficult than our how to say practice. So if you feel bad about this one, you don't have to. I just want to use it to give me give me a few things. All right, a few things. I thought of publish the homework late, so I didn't give a specific deadline. I didn't check your homework yet. If you haven't, you can still finish it. I probably just give all. I will give the grades, finish grading your exam during spring break. So I'm gonna give you 10 minutes. Can you write? Let me see. I want you to write step 1, consolidation step 1, step 2, and step 4 for me. We good? I'll give you 10 minutes, right? Now it is, what time is it? Now it is 54. So at 5 past 8, we're gonna meet briefly again and write down consolidation journal entry, step 1, step 2, and step 4. Okay, just 3 steps. That should be good enough. So we can all feel comfortable about it. And I will upload the thing we did in I will upload the video as well as the consolidation we did together, okay? 10 minutes, 1, 2, 4. Okay, so I think it's pretty easy. Many people probably figured out already. So let me ask, for us to do this, what do we have to figure out? Right here, we are taking a look. Big purchased 60% of small stock by paying 3 million cash and issue new shares to as small former shareholders, 600,000 shares with $1 par value and a $10 market value. Right from this, we know it's a 3 million cash plus stock equity amount of 6 million, right? So total investment balance is going to be 9 million here. 9 million is about a 60% of the company. So we know that the whole package in the eyes of small, in the eyes of big, the whole package value of small in the eyes of big is 15 million. Did we all get this?
Yes.
Yes, okay. Looking at it. So given the 15 million, we know the how much is the net value, net market value of identifiable assets and liabilities of small again? How much is that?
Is it 12 million?
Oh, what 12? I didn't calculate. Let me see. Sorry. Let me
It's
see.
9 million.
Where did you get a 12, right? We add everything here, so market value, everything. You know, I didn't cover this, just want you to be aware of this. Loan has market value difference between market value and the book value as well, right? When market rate change, we know like last year, a lot of people did a refinancing, right? Because the available rate, market rate was lower than many people's original borrowing rates. So the loans liability can have different market value as well. Just want you to know it. And about the market value, we know, we just look at it here, right? So total market value of assets minus market value of a bank loan. I think that's how Amado got it. So here the total is 9 million. So what do we get? Goodwill, how much? 6 million, right? So with 6 million, I think it's going to be easy, really easy for us to do 1, 2, and 4, right? I don't think it's necessary for us to do it again. So the reason I'm mentioning this is I want us to be able to. So here, I really want us to be aware, right? When we talk about a consolidation, first thing you ask yourself is whether there is goodwill or not. And in our context, usually there is goodwill. So that's a reminder for you. Usually there's goodwill. So think about how to calculate goodwill, right? And think about how to calculate the investment income, how to do the adjustment 5 steps. Okay. Think about it, and it should be easy for you. I'm gonna, after this class, I promise, I know it was kind of late. I promise I'm gonna tonight. I'm gonna upload the video of our class, and I'm gonna upload the worksheet with all the equations. Okay, so you can refer to it. If you are really in a good mood to study, you can probably find it in Blackboard like at 9. All right. Otherwise, you can go to bed and wake up tomorrow and find it there already. So our exam will be available Saturday and Sunday. All right. Enjoy your spring break. Are we good?
Yes, thank you.
Okay, yeah. That's kind of all right. So take care.
Thank you.